I'm Mike Riley here with my colleague Lynn Lincecum. We're professional realtors at John Rea Realty here in Monroe, Louisiana. Today, Lynn and I are talking about the dollars and cents involved in investing in commercial real estate. Lynn, if you're evaluating a piece of commercial real estate as an investment opportunity and you're trying to make sense as to whether it's a good investment, what do you look for?
Well, whether you're selling or whether you're buying
right.
commercial real estate, first thing you have to decide is what? How much? What is it worth? And so there are three primary methods of evaluating the worth of commercial property. The first one is replacement value, and this is used primarily by insurance companies and to some degree financial institutions. To what would happen if the property were totally destroyed, what would it cost? How much does it need to be insured? But in our business of buying and selling real estate, we rarely use that. We try to determine the value of a commercial property usually in two areas. One, what does the market value the property? And the other is the income approach, which sometimes doesn't really have anything to do with the market value. Let's take the market value first. Much like a residential property, an appraiser will value the property based on similar properties in a given period, in a given area, during a given period of time. And those are, as we know, are called comparables or comps for short. They'll make adjustments, of course, on those, and they'll come up with a value. But truly, the value, because it's based on what has happened recently and what the market is paid for property, the market determines the value.
Exactly.
And so some commercial properties are based, values are based on that, on comps. The other, of course, is from the income approach. Many times the income approach may not necessarily be aligned with market values because you could have a piece of property that the market may value very low, but yet it may produce high income, and an investor would be very much interested in that. The income approach, of course, is by taking the potential, whether it's already happening or whether it could happen, is usually going to be determined by the buyer and whether they want to take the risk and what level of risk they want to take. After revenue is determined, less expenses, you come up with a net profit or potential profit of the property, whether it's apartments or whether it's a strip center and you're leasing out parts of the building, or one building with one leasee. That usually, the percentage of that, using a 10% cap rate, which is a term that is used in this business, and it's important to investors because they like to have a 10% return on the initial investment. So if the net income is, for instance, $100,000 at 10 cap rate, the value of the property from the income approach is $1 million.
Right.
And so, and the reason 10%, because most investors have to build in some risk factor, the possible vacancies and other things that they maybe can't foresee.
Very good. And you and I, of course, have some specific properties in mind to offer at this current time. Tell us a little bit about what you have on the market.
Well, one is a property that has a lease in it and has a long-term lease, and it is a company that services automobiles, an oil change service company. And since that property already has a lease on it for at least the next 12 years, that's a good piece of property for an investor because the most important thing to an investor is how low is the risk. And if you have a big corporation who is guaranteeing the lease, even though that one location might not do well, that's pretty secure, or at least more so than most other commercial properties. In this case, which we visited today, Jiffy Lube is a national company, and The franchisee is, of course, a different name company, and they have about 100 locations. This is one of them in Monroe. So in this case, you would take determine the value of the property, you would take the revenue less expenses and come up with a net profit for the year. In this case, it is a net lease, meaning that the leasee pays the taxes and the insurance and also some of the maintenance costs. So basically, the revenue is almost 100% net profit. So that using that net profit would determine, in this case, it's approximately a 10% cap rate on that property. The other one we looked at today was a strip mall, where there are 5 units in this property, and each of the units would pay a lease to the owner of the property. And in this case, you would also determine the value of this property also from an income approach. Again, after the total revenue, less expenses, you would come up with a number. And again, that would be used to determine what the market value on the income approach. Mm-hmm. Sometimes the properties are located in such a good location that sometimes the people who are determining the value of it will use both methods, mm-hmm. because the land under it is valued so high. They use that along with, in other words, market value. They use that along with income approach to come up with a sort of a combination of the two values to come up with a value. Mm-hmm. The third one that we looked at is a office building that could be sold as a one user, one mm-hmm. company buy the office building, which is approximately 5,000 square feet, located on McMillan, which runs by the hospital in West Monroe. So someone could buy that property and occupy it as a business and occupy the whole building. Right. They would probably determine the value of it based on the market value, because they're not leasing it out, they're going to actually use the property. So they would want to buy it at whatever market value is, and so probably that building in that case could probably only be sold for what the market has determined it's worth, using comps and comparable sales. But someone buying as an investment who wanted to put 2 or 3 leases in the building and divide it up, which is somewhat like it is now, they would only be interested in valuing an income approach, because they're making an investment and they want a return on their value. So there's a case where they really wouldn't care what the market value is. They only want to know, can I purchase it, lease it out, and have a return on my investment.
Good thoughts, and you have helped to boil down a complex subject to some real clear bullet points, and that's what we do here at John Rea Realty. We have a staff of 8 full-time commercial realtors, and so if you're looking for expert help in deciding about buying or selling commercial real estate, we are the place to go.